Welcome back to Sibos TV, everybody. You're watching our lunchtime report on this day one of Sibos 2013 here in Dubai. Now, we've been talking a lot about regulatory burdens. Our last session, we talked about it, and we're going to talk a little bit more about the price of it, the cost that is involved for all of the financial institutions that are trying to grapple with the regulations that they have to implement since the global financial crisis. Well, joining us to discuss this and some of the challenges and the issues looking ahead to the future as to what we can expect as well are Dominic Hobson. He is the founder and COO of Connect. Also with us, Matthias Papenfuss, COO and member of the executive board of Clearstream Banking. He's going to speak from the point of view of a CSD. Larry Thompson is with us from the Trade Repository. He is a managing director and general counsel at the DTCC. John P. Berry, or JP, as he likes to be known, is the Chief Executive Officer of STAT, a CSM, and Rebecca Turner is the Executive Director, Policy and Regulatory Affairs at ASIFMA. So that's an organization in are you based in China, in Asia?
Hong Kong.
In Hong Kong. So in China, yeah, great. So thanks very much to all of you for joining us. Let's start with what the main question of this particular interview is, and is it the fact that the cost of regulation, is it making the system safer or less safe? So Dominic, how has this concern even come about?
There is a concern that risk is being transferred from bilateral market participants from banks into market infrastructures, notably into CCPs. Now, CCPs, one of the findings in our discussion was that CCPs are very thinly capitalized. They're being asked to take on enormous quantities of risk. They're being asked to take on new risks like OTC derivatives, which they have no experience up to this point. So they're taking on more risk on a very thin basis of capital. Of course, they're collateralized. Of course, they don't pay anyone until they get paid themselves and so on. But I think there is a genuine concern that in the event of a major counterparty default, a CCP could go down with potentially large systemic consequences.
So, Matthias, you're speaking from the point of view of a CSD. Tell us what you think. Is the system getting safer?
Will definitely get safer because there is the theme of concentration of risk, but in parallel to that, we have to look also, it's not exclusively about concentration of risk. It's also about creating the right level of transparency, because risk is concerning you much more if in the unknown than what you know. And taking Lehman as an example, I think people calmed down a little bit once proper numbers were available. So you were managing much more the known dilemma than the unknown dilemma. And in that context, I believe it's the right direction to move these type of businesses into market infrastructure who have proven to be resilient during the crisis, who have been safe havens even in certain instances for market participants, and subsequently this is the right way, but it has to be managed by the right level of transparency as well.
So what would a CSD like yours expect to see? What are the specifics if you had a laundry list?
What we are going to expect is that there are specific prudential requirements being, let's call it, imposed on us from a CPSS IOSCO principles point of view, where certain prudential requirements on the way we are operating, on the way we are managing our business are going to be published, and we are being measured against it. On the other side, this framework will allow us to develop new services. And specifically from a CSD point of view, collateral management is one of the key themes which is coming up. From a Clearstream's perspective, we are in that part of business since a long time, and we have seen quite a lot of take up on these topics, and we are cooperating with many partners around the world on that topic as well in order to enable them to move in that kind of direction.
One of the themes that came out of our discussion was that this emphasis on market infrastructures forces established providers like Clearstream to adapt their business model. As a point that Larry made very strongly is that it also brings into the marketplace lots of new and innovative players. Of course, they might represent whole new risks, but certainly market infrastructure opens the market up.
So Larry, tell us about some of these new innovative players that are on your horizon.
Well, I think there are a number of things that are going on. There are a lot of market participants who cleared through other organizations previously who've now realized that their risk management is something that they have to handle directly. So they want to be part of the system and want to come in, they want to understand the risk that they'll be absorbing. So one of the key things I think that we at DTCC want to focus on, and by the way, we run, CCPs, 3 of them, a CSD, trade repositories, as well as cash payment systems, is we want to focus on transparency. We want to make certain that all of our participants understand clearly what our governance is, what our risk mitigation techniques are, what our exposures are, what exposures they have to us, what exposures that we have to them. As was stated earlier, the infrastructures did very well at the beginning of the crisis. We at DTCC, for instance, when we closed out Lehman, had 539 billion of open positions that we had to close out.
Wow.
We did so successfully. And what we need to do is make certain that when the next crisis happens, and there will be a next crisis, that we can handle that as well as we handled the last one.
You say there will be a next crisis. We know the world isn't perfect. Any indication where you think that may come from?
I would not hazard a guess, but I'll leave that up to my colleagues.
It'll definitely
here if they
come from
want to take it.
I think
CCPs.
it's definitely come from the CCPs. So I say, being asked to take on a great volume of business and new business which they're not necessarily qualified to conduct.
Let's bring in JP, talking from a CSM perspective. You've been listening to this conversation. What are your views?
It's a little bit a different situation because CPSS is a very wide net and a interesting trial to have one regulation for very different beasts. And the biggest parts of the beasts are the securities because the financial risk is much bigger. In our case, unfortunately, we just watch money going through, but we never get our hands on it. So the financial risk is much more limited. On the other hand, we have a very high concern for operational risks. If a system like ours stops, essentially the country's economy stops very, very rapidly. People don't get paid and they get pissed. So we're set up in such a way that if an atomic bomb were to fall on the Paris region, and if people are still around with an urgent need to make a payment and they get that payment order to the bank, I guarantee we will process it. We're expecting much lower volumes in that case, but we'll still process whatever will be available.
Well, that's definitely good to know. I want to get to Rebecca because this seems to be the sort of European part of the group, speaking from pretty much a European perspective, I'd imagine. But you sit in Asia. Tell us what you've been seeing there.
Well, I think the question about cost versus risk is an important one, but it's not the only consideration. I think moving a lot of these transactions onto infrastructures makes the system in and of itself more safe. Does it come at a cost? Yes, it does. But the risk also comes at a cost. So, it's one or the other, and sometimes it's both. So I think it's important to recognize that the discussion that we're having about the potential risks and future risks, whether it's another crisis emanating from a CCP or a default of multiple counterparties, things that we have yet to experience and the systems are generally untested, is really important because not only the regulators are thinking ahead, but the market participants who have skin in the game are thinking ahead. And I think that ultimately will strengthen the system. And something that Larry said a little bit earlier about transparency, I think that in the analyzing the risk in the old system was not transparent and therefore much more difficult to do. In this new system, you open up the window to transparency where different stakeholders can analyze the risk more efficiently.
You wanted to say something?
I don't think we should let Jean-Pic get away with saying that payments are different from CSDs and CCPs, because I think CSDs and CCPs would also say that it's a wash. We don't pay anybody till we get paid ourselves. And I think the forgotten element in this is that CCPs in particular is a collateralized business. And so in effect, you are repackaging counterparty risk as risk in the markets for collateral. And if the collateral markets dry up and you cannot lay your hands on eligible collateral to post to a CCP, you will go into default and a systemic crisis will ensue from that.
Come back on that.
Yeah.
We never own anything, which I believe you do. And besides, the value of what we have doesn't change through time. €1 is always €1. So we have no risk of variations in value, and we don't support directly the risk we have. Financially, the only risk we have is one of the major banks from France defaulting, in which case very frankly, it'll be a problem, but the low value system will be just an itty teeny weeny bit of the problem, because what they'll have in a high value system will probably be 1,000 times, literally 1,000 times higher. Will be maybe a problem of, I don't know, 50, 100 mil, that's nothing. An RTGS will probably hang around with 30 or 40 billion euros, and we have a much bigger problem.
Everybody thinks that it's somebody else's risk, and it is one financial system. And if any piece of it goes under, it's going to have wide-reaching effects on the entire system. So to say it's not my risk, or that your risk is bigger than my risk, I don't think is going to move the discussion in the direction of making it safer for all the financial participants. And I also believe strongly that a one-size-fits-all model of analysis or regulation isn't going to protect the system, and it will have many unintended consequences.
That's a very important point that Rebecca just made. We have to deal with all of the risks. Operational risk can lead to systemic problems in the system, which could lead to a systemic failure. And that could happen at a CCP, it could happen at a CSD, it could happen in payment systems. We run payment systems, we have CSDs, we have CCPs. We've seen all of those issues. The other thing which I agree with is that you need principles that all of these systems have to adhere to. Now, obviously, there will be individual situations. There will be law situations, jurisdictional situations that will be different. So you will need to take the principles and modify them appropriately when necessary, but we need to start with a common set of principles on a global basis.
Who should be doing that?
Well, I think at this point the regulators are doing so at a number of levels. There's IOSCO, CPS IOSCO, which have come out with 24 principles on a global basis that we can all look at. We can all comment upon them. They're in a comment period now. We need to talk about that. We need to come up with a standard understanding, and then the local regulators need to adapt that to your particular needs and responsibilities.
But that is where consistency is important, because having global standards on the one hand is fine, but having then a diversified implementation scheme across different national or domestic markets, and where the real problem starts.
Well, it may be an argument to really have a WTO for the financial services industry. You know, a organization that has legal teeth that can enforce these standards across jurisdictional lines. We don't have that in the financial industry. There's a strong argument to be made that is something that should be put in place so that we can enforce the standards that we've all been talking
Rebecca's
about.
chomping at the bit.
Well, I think this is a really important discussion, because the implementation of a lot of these global standards in Asia have real economy impacts. And I heard a consortium of Thai regulators discussing a lot of this reform agenda and made a really apt analogy, which if you'd indulge me in sharing it.
Sure.
Basically, they said, we're being asked to make a state-of-the-art elevator for a 100-story building, but when I walk outside and I look at my market, we're still at 1 story. So yes, we need international standards and we need to protect the financial system as a whole. But I also really believe that some of these standards are not fit for purpose, that they're looking at regulating markets that don't yet exist and have not had the opportunity to develop in Asia. And therefore, there needs to be some consideration of the impact of this regulation on the real economies.
Final comment from you, Dominic.
I think we have a similar issue in the developed markets, where regulators probably want a different thing from what the market participants want. And the poll in our panel showed this very clearly. Regulators want to reduce systemic risk. Market participants want lower operational costs, lower greater efficiency. Now, whether you can get those things through consolidation or competition remains undecided. We're in a world now with 150 CSDs, 85 CCPs, 380 payment systems, and 22 trade repositories. Everyone expects that to consolidate. Will that undermine competition? I don't know. That remains an unresolved discussion. But at this point, the market participants and the regulators may be pointing in different directions.
Okay, well, we've got to leave it there. Thanks very much. Very interesting. Thanks very much for all of you for joining us.